Welcome to the Freedom Finances Show. This is Bradley here with Nick. It's just the two of us today. Today, we're going to be talking about some bonds. We're going to talk about how to set up your retirement and not just focus on the stock market. Over the last few weeks, especially a couple weeks ago when the stock market dropped, a lot of people freaked out about their retirement accounts, those who were near retirement or in retirement, and it can be scary. So one of our goals is to discuss what it looks like with retirement and not just focus on the stock market. So if the stock market has a few bad months, what you can do. So let's start off, speaking of the stock market, with our investment draft. And right now, Nick, you're at minus 12.75%. Sorry, I'm laughing. You did go down from last week, but not as much as I went down. So out of $100,000, you currently have $87,247. And I'm down 9.05%, which is worse than last week, just not as bad as Nick. So I have $90,954. So looking at the chart, Nick, Starbucks is in last, minus almost 39%. And in first place, am I seeing this right? T-Mobile. So we got Starbucks. Amazon's bad too. Starbucks and T-Mobile. So tell us what's going on there.
Yeah. So, I mean, there's been a lot of things in the news about both Amazon and Starbucks. I think we were joking about Starbucks really focusing on the important things with their uniform
the color of the T-shirts. Yes.
Yeah. Really attacking the problems there, Starbucks. I appreciate it. No, I think, it's just I said it a long time ago, a lot of things were overpriced and overvalued. And I think that was a perfect storm. And, Starbucks and I think Amazon too, really getting hit. And I think Amazon specifically had a really high price to earnings ratio. And without that, guarantee of future growth, I think people just get a little concerned that they can't continue to grow the bottom line and stuff like that. And so the traditional stocks that everybody thought were the blue chips, they're never going to go down. I think with all the uncertainty, they'll tariffs that we've talked about once or twice. I think people are scared. They don't know what's going to happen. I think, if you look in the news, did you hear about the whole China economy with luxury brands trying to basically sell them direct to consumer for a fraction of what they're being charged, like Rolex, Gucci, like different things like that. I think people are worried that those types of things are going to affect companies' bottom line. And so, they're scared. I think earnings are going to have to start coming out strong in order to get people to feel a little bit more confident. I think companies like Starbucks and Amazon in the long run will still be good. But I think in the short term, it's a little scary, and thankfully T-Mobile has been carrying me through, or else I'd be even lower. They seem to be doing pretty good. So I'm happy for that.
It's funny that you say that. Netflix just released their earnings report yesterday. I actually talked about it in our news today, and I think they hit record growth. And this was after the stock market closed yesterday, and they're up after hours trading. So there's a good chance next week when we talk about this, Netflix will help you quite a bit. Like I said, a month or two ago, it's all about earnings and profits. That's what's going to lead us to see profits again. But I'm excited to play this out. Let's see. Looking at me, I have, it looks like Meta is in last place for me, minus 30.1%. Jeez, freaking Facebook.
What's happened with Meta?
I don't know. The last I saw was that they had some issues with some chips for their AI, and they said had some clientele issue. I mean, it's not necessarily someone who you traditionally would think is going to be impacted by tariffs. When you look at computing power, a lot of our chips come from Taiwan, right? So I think President Trump slapped Taiwan with a bunch of tariffs. Obviously, he took them off. for a while. So who knows what's going to happen with that? But they've had some rough times. I will say, Berkshire Hathaway Fund B seems, no matter what happens, they always seem to go up in some way. So I'm at positive 9.8%, which is, that's good for any fund within, we've been doing this, 2 months, to go up almost 10% in 2 months. So yeah, so Berkshire Hathaway, I don't even own any in real life. Do you?
I don't think I could afford to own one share. But so, hey, so question for you, because there's a second Berkshire Hathaway that trades at a lower price. Is it seeing the same increase?
The fund I have is the cheaper one. I have the 500. So my fund, when I bought it, was at 471. The Berkshire Hathaway B now is trading at 518. So yes, it's gone up.
Okay.
The fund A is what, like $200,000 a share or something?
Isn't it like 700,000 a share?
Let me look this up.
I think it's something ridiculous.
Yeah. Let me look this up.
Yeah, now I got it. Yeah, it's $778,000.
That's more than the cost of a house.
Yeah, you can get a couple Bitcoin for one.
Yeah, so those, you're right. We can't afford either. Berkshire Hathaway Fund B, it looks like is down a little bit, or A is down a little bit. B is up. So, hey, I picked the right one.
Yeah, you did.
And hey, guess what? I haven't lost a single dollar on this 5-year CD.
Are you going to get paid out any interest on that soon?
We'll see. I don't know what the coupon rate is. I'll have to check it out.
Oh, okay.
Well, all right. That's our update for the investment draft that we're talking about CDs. Let's get into bonds. I talked about bonds, especially treasury bonds, as one of the most secure, low risk investments. If you think of a treasury bond, you look at one of the most low risk because it's backed by the American government, which is essentially there's no other entity, whether it's a firm or anything or a local municipal, there's nothing that's more worthy of putting your money into other than the American government, at least from a risk level. So let's start off with this question, Nick. How we'll get into retirements outside of stocks, but how much value, not necessarily a dollar, but how much value do you put bonds in your portfolio, or how much value should we have when we're thinking about our investments?
Yeah, I mean, bonds are a little different from your traditional stock because I think, on a stock, you're hoping for the company overall to increase in value. With a bond, you're just hoping the company doesn't default on its debt, So I think it's a little bit more, it's more secure. There's obviously still risks involved, but I think if you're picking, blue chip stocks and things like that, you're probably in a safe spot, but it's always going to be a risk versus reward. The lower risk, the less you're going to get paid off of it. So I think, the upside is traditionally you'll have a little bit wider options with what interest rates and stuff you get paid on corporate bonds versus your municipal bonds and government bonds and things like that. But I think, every good portfolio should have a good mix of it. And I think as you get older and closer to retirement age, you should have a larger portion of your portfolio into bonds. I think when you're early and you still have 20, 30 years to go, you're probably looking at 10, 15% of your portfolio that should be kind of bonds, and maybe a mix of whichever ones you kind of like. But yeah, I think as I think to your point, if you were in retirement stages within the last couple of months, hopefully your portfolio has a bigger percentage of bonds, which would have less, volatility based off what the market is doing right now. So I think it's just a nice, safe way to be able to keep some money that earns you a little bit of extra cash without risking the market going crazy, because the likelihood of these companies going bankrupt, is low. It's never zero, but
Yeah.
they're probably going to repay their debt as long as you're picking decent corporate bonds and not just going for some crazy triple
Yeah.
B rated company or something. So
So it's funny that you said that, like like a poorly rated company. Like I think of a bond in my investments like CDs kind of. So here's how I use them. I usually get, and I think right now I'm just solely doing CDs instead of bonds. Obviously, I still have money in the stock market, but if you have bonds and let's say they expire in 12 months, for example, you can get money back into your portfolio with interest, right? A coupon payment, and then you can decide what to do with that money. Obviously, you could keep redoing that, or you could, like, let's say you had a bond that just paid out. Uh, right now, then you're like, hey, the stock market's down. Now I have some free cash to put into the stock market. And I actually had that with some CDs that paid out a couple weeks ago. And I was like, oh, I can put some money into the stock market. Like, obviously, my whole portfolio, like everyone else, was down, but I had some free cash. I could throw it into the stock market. But I think when it comes to risk, you have corporate bonds for big companies, big banks, which you like these firms will most likely pay out on them. You have treasury bonds, like a US treasury bonds, which could come in 10 years with coupon payments, or you could have a municipal bond, which are fun because you can like invest into like a local city or something, which is more high risk than something like a treasury bond, but still relatively low risk. So I guess like if you were to do a bond, and not saying you have to give the right answer, but how would you use bonds like as a 35-year-old today?
yeah, I think that for me personally, I would I'd probably do a little bit of a mix, right? I think they, just kind of looking through bonds right now, I think you can get anywhere realistically between 4 to 8% yield on a lot of these corporate bonds. Obviously, the higher ones are a little bit more risky and things
Right.
like that. But I think having longer to go, you're able to put a little bit more, risk, and I think, just for people who don't know, bonds are usually done in increments of $100, right? And so as I'm looking through some of these bonds, there's some that you can buy for $80, which at maturity would pay out $100 plus any sort of coupon or, interest that bond would pay. But for instance, this one doesn't mature until 2035, and it's a
I
B
was gonna say
minus.
that's a good return, but you have to wait.
Yeah.
Yeah.
But it's a triple B minus rated company. It's a Panama rep bond call, and I don't even know that company. So,
No.
you're kind of betting, is that company going to be around in 10 years? Maybe, but it could be a decent risk. You're not putting
Yeah.
your retirement at stake for it. So I think that, a 10% for me would be the safe kind of, 4 to 5%, and that you're getting maybe a little bit better than a CD, and then maybe 5% get a little risky. Get some of these
Sure.
that might pay out pretty decent, in a few years, 5 years, something like
Yeah.
that. But if nothing else, for me, it just it allows me to learn as I'm buying these bonds, like how do they move? What's the resale market on them? What market factors will trigger them to go up or down in value and things
Right.
like that. So yeah, I think it's a good way to just learn them a little bit and maybe do some things that you couldn't if you were closer to
Yeah.
retirement age.
Oh, okay. So let's keep the bonds in mind and move into retirement. So I saw this somewhere. I think it was on X. So like this was maybe 2 weeks ago when the stock market was like really scary, and one big like we kind of joke about it like, hey, in a couple months we'll be fine. But if you're retired and all your money's in the stock market and that's what you live off of, it's an actual concern, right? So I thought of the question like, how do you have to like, how do you make sure that you don't focus solely on the stock market for your like for your rent, when you're 65? So let's talk about that. Let me just throw this out there for you, Nick. If you're 35 right now, which we both are, how are you going to make sure that when you retire, let's say in 30 years from now, if we have a bad, let's say 18 months in the stock market, other than the fact that it will kind of make up for itself, how do you focus on, I'm not just going to focus on retirement just on the stock market?
Yeah, I think, we talked about other kind of investment options and things like that. I think we went a little crazy with Pokemon cards and Legos and things like that. But, I think for your average, just, folks like us, you've got your home is probably going to be your biggest asset. And I think a lot of people, I don't know if this is everybody's plan, but I think as you get older, you usually transition into a smaller type of home. So maybe sell and then, downsize a little bit and use some of those funds. I think that a well-balanced portfolio, which obviously has, stock market portions in it, but also has bonds and different, assets like that. Maybe even, I think we talked about precious metals, gold, silver, platinum, things like that. I think that you also have to think about your debt. Reducing debt into retirement, I think makes a lot of sense. I know it's not really the question, but
no,
I think it does play into it a little bit. But then, really, I personally, I want some sort of asset that will generate income, and I think people can do that through rentals. Heck, people are even doing like Turo and renting out their cars and things like that, but just something that could bring in a recurring revenue, because when you do retire, you may not be able to work and have that. Maybe it's dividend paying stocks. Maybe it's, CDs, different things like that. But I do want something that allows me to have access to funds on a consistent basis. So yeah, that's kind of my thoughts. What are you thinking?
So I thought about this question a lot, and I did like a finance tip of the day, which is don't go into retirement solely relying on the stock market. Obviously, you're going to build most of your wealth through the stock market through the 30 to 40 years that people work. I think for me, and this is difficult, but for me, number one is like to figure out how am I going to pay rent. So like that's usually everyone's biggest expense, and then medical care is probably up there, especially for people in their 60s plus. But paying rent is the biggest thing, right? If I'm renting, then I don't own an asset and I can't get rid of that cost. If I have a home, both you and I are homeowners. Like by the time we retire, just with what our mortgages are, they'll be paid off just as it is, right? Within the 30-year mortgage. But let's say I think that people who are 50 can work, like they can buy a new house and work to pay off that house before, even with the 30-year mortgage, before they get to retirement, let's say at 65. So I think that's a big thing. Like not everyone can deal with this. And, if there are people in their 60s, it's difficult. But for me, number one is mortgage. Like, how do I reduce my rent payment? And I think like, okay, let's say I am where I am today, but I don't have a mortgage payment. Like, dang, I have a lot of money, like like right now mortgage payments for new homes are starting, or like for $300,000 house, that's like $3,000 right now with what the way interest rates are. We could refinance and blah blah blah, but let's just say $3,000. Like for the normal family, if you no longer have to pay $3,000 in a month, awesome, like that really helps. So that's number one for me. And then like when you said this earlier when we were talking about bonds, like increasing the amount of your portfolio into bonds or CDs, like very low risk, relatively low payouts, but they do pay out. And depending on how you do it, you can still beat inflation. But if you still have all your money in a 401k, that's usually fine for most people. But your IRA, fortunately, most of the stock market's going to take over for you. You're going to build up that 10%. Let's say the stock market makes you spend 4%, like the 4% rule you talked about, you should be fine. But when it comes to these bad times, you have to find a good wiggle room. I would start with the mortgage. I would start with rent first and foremost. And then I would go to increasing my portfolio into CDs, bonds, what have you, those things that pay coupon payments. What do you think?
Yeah, no, I think that makes sense. I am curious, like the renting thing, obviously I like in my mind, it's like renting is that thing that you do when you're going to school. And,
Yeah.
once you turn like, 25, you go and buy a house. Like, do you think a lot of people, even into their retirement years, find themselves in a position where they can't buy a house and they have to continue to rent? Like, is that a really big obstacle
I,
into, retirement?
I mean, I guess think of it this way. Let's say you have a couple, their kids are all graduated, they're in their 60s, they retire, whether it's for health issues or they're getting old, and they're not, like, their income is essentially their 401k or, an IRA and or Social Security. There's a good chance that they can't afford a $3,000 mortgage, so they would have had a 30-year mortgage paid off and either get that money in rent and use that money for savings, or like live in that house rent free. But yeah, I think it's a real issue. I mean, a lot of the my family members that I know in my age, or like of my family, who are in that retirement age, don't own a house, or like maybe they were hurt in the 2008 mortgage crisis. It's difficult for people in this current retirement because the 2008 mortgage crisis really hurt a lot of people, like our parents' generation. So yeah, they're struggling, and they're struggling with rent, or at least being able to put themselves in that situation to not rely on a mortgage. For me, I understand that's the most difficult thing. Is like I have to plan for the last 20 years.
Yeah, I think a couple things. And obviously everybody's situation is a little bit different, but I think that it's I can't remember where I saw it, but every year that you extend your retirement, it's like basically the best guaranteed return that you can get
Yeah,
from like
yeah.
Social Security and things like that. And I know that's probably a hot ticket, like is it going to be around when we retire type of thing. But for the people that are in that situation now, delaying retirement age is definitely something that's going to be able to get you a few extra dollars in
Yeah.
your pocket as much as you possibly can. And then another one, which I don't know if a lot of people look at this, but I think they just raised it to 35 years. But if you go back and look at, the way they calculate Social Security, they basically take your 35 years of highest income that you've had and then do that. And some people, if they don't have 35 years worth of, working history, that year counts as $0. So being
I didn't
able
know
to
that.
add those, it does. Yeah. And some people, if you have 35 years, but some of that's when you were right out of high school and you maybe made $30,000 and right now you're making 100,000. If you work one more year, you're basically replacing one of those 35 years with 100,000 versus 30, which will
Oh,
increase your Social Security income. So I think, you've got to be strategic with some of those things as well when you go into retirement,
yeah.
because honestly, like having that rent, that is a huge problem because it doesn't go away. You're not
Right.
investing in
Yeah.
light at the end of the tunnel or anything like that. So I think you just got to be strategic with some of those things, because I think even when we talked about retiring in this day and age right now with the stock market volatility, just decrease your spending. You can't do that if you've got a monthly
Right.
rent bill that you've got
Yeah.
to pay. So
Yeah.
I think you've got to maybe think twice before you actually say, hey, I'm going to retire. Or maybe, semi-retired. I think you're able to still work a certain amount. I don't know what the exact numbers are,
Hmm.
and
Yeah.
still draw in retirement. So maybe that's something that you'd have to do. Again, everybody's situation is different. Maybe you don't have the ability to, but yeah, I'd say be cautious for sure.
I think I didn't know that about Social Security. That's interesting. But I mean, it kind of applies to like compound interest too. Like if it, I'm a nerd, so I have a compound interest calculator in Excel that I made, and like every year that interest grows so much more and more and more. So I am a proponent, if you can work longer when you need to, leave your funds alone, let compound interest do its thing for a couple, like 2 extra years can help you out quite a bit. Plus the Social Security thing, that can definitely help you out. So, okay, speaking of compound interest and money just blowing up over a couple years, Nick, outside of Freedom Finances, we talked about 3X funds. Why don't you, first of all, let's go ahead, explain what a 3X fund is for anyone who's listening.
Okay, so where I learned about this first is there are these funds that basically they take a stock or an ETF, and they seek to double the either gains or losses that you get from that, right? So I learned that Tesla has a 2x fund. And so if Tesla goes up 1%, this fund will go up 2%. The downside is if it goes down 1%, this fund will go down 2%. And so essentially what I learned is they accomplish this by having a mix of like options and different things like that to achieve that financial gain, which makes sense because an option is going to lose more money if the stock goes the other direction. So take VU, for instance. We know that is a combination of all the S&P 500 stocks. So essentially what there are, there's 2, 3, 4, maybe more. I haven't gone, but there's these funds that seek to, 3x the S&P 500. And it's really interesting because it's, if you ever go and buy one through a traditional broker like Fidelity, you'll get the little message. It's like, hey, this is not meant for long-term holdings. This is meant for day trading and things like that. And I didn't really understand why. So I kind of did some research, and there is a rebalancing of the funds at the end of every day. And so when you look at it over the long period of time, like it doesn't necessarily always track 100%, 3 times that fund. On the daily, it's pretty dang close to 3 times what the S&P 500 will do. But when you take a step back, it changes a little bit. In fact, I did a little bit of research, and one of the funds, I think it was the 3X fund, while the S&P 500 had, I can't remember exactly how much it was, but it was like a 50% increase in a certain time period. This had like a 500, 700% increase in that same time period. So it was more than the 3X. And so I don't know, I'm still playing around with them, but it definitely does on the daily go up and down at 3 times whatever the S&P 500 does. But I just wonder if you hold on to them for a long period of time, if the S&P gives you 10% a year, on average, will this give me 30%? Right. Now, the fees are higher. I will tell you that. Okay. So as you're holding it, the fees are much higher than VU. It's almost 1%. So that's huge when you look at ETFs and things like that. Right. But if you're making 30% instead of 10, maybe it's worth it. I don't know.
Is that fee worth it? So okay, the most obvious risk is if the market goes down, which it's gone down, over 5% in the last month or so, you've gone down 15%. But I mean, okay, here's like the kind of like, I can do this mentality is like, if it goes up, like you said, 10% every year over 20 years, that's 200% or whatever. This will go up 600% or whatever the math is. Why, like, okay, what if, let's say the market averages 10 over 5 years, that's 50 times 3, 150. What risk is there to long-term hold it?
So I think that from my limited research, which I'll continue to get more educated on, the risk is volatile markets like we're in right now. These are extremely risky. And I think logically it makes sense, right? So if this tracks 3-4 times what the S&P 500 does, well, what happens if the S&P 500 drops 25%?
Right.
That's 100% if you're in a 4X fund. Yeah. So imagine, and so now I don't know how the math would work on that exactly, but when the market dropped 10%, I dropped 30. You know, and so when you look at a fund that drops that much, or the possibility of dropping that much, it might be very hard to recover. You know, not a lot of people are going to want to invest in a fund that has lost 100% of its value or close to it, 90%, anything like that. So there is a risk that the funds go down and just never recover.
Right.
Now, in markets that are, you know, more stable and going up and things like that, I think it's very little risk other than the fees that you have to, you know, pay. But right now is probably the riskiest time to have one of these stocks or ETFs, just because, you could see a 20% drop or something like that, and wipe out a significant portion. So I would definitely say if you are going to invest in these, like, do small amounts. Don't try to put your whole life savings into it, and see what happens. You know, learn. It's definitely not a put it all on black kind of situation.
So okay, you brought up some math, which I don't think a lot of people understand. So this came up a lot, especially around the political and ideological discourse of President Trump's tariff. The stock market, I think it dropped like 10%. And then like it had 2 days of like a 4% and a plus 3%, something like that, right? And people are like, hey, it's only down 3%. That's unfortunately not how math works. So like, just to make it easy, you have $100, you lose 10%, you're down to $90. Let's say you gain 10%. Well, 10% of 90 is only 9. So you're up to 99. You're still down 1%. So I think your math with what you said, like something like let's say a 25% loss times 3, 75, it's going to take a long time to make up that money.
You have to think like in a, you know, if an ETF dropped 90%, you know, it went from $100 to $10. You now have to 1,000 times that to get from $10 back to 100.
Yeah, if you add 90% to 10, you only have $19.
People don't realize that it's you know, even when the market dropped and then we had a 30% increase or whatever it was, it's like, well, but it didn't make up what it actually dropped already.
Exactly.
We were like halfway back to where we were. So good point.
Yeah, so I think that is like with the 3X funds, or to even you and I were talking about it personally, like the more you break down the math, the more it's like, wow, one bad week can, like, it's going to take a long time to make up that, just because the way math works, you know, and the way percentages work. So that's a good one. I think it's good to think about, because I think like mentality, especially like people like you and me, people who like have like kind of that fear of missing out, like, what is this? I want to understand this. I got to throw some money in, and then you kind of go all in. But like the more patience you have, the more literacy you have around these issues, the more you realize, okay, it is high risk for a reason. And the more you break it down, the more it's like, okay, maybe I can do it, but it should be a small part of my portfolio.
Agreed.
All right, let's talk about, okay, so you talked about VOO, which is an ETF. You had this thought earlier around ETFs versus closed funds. What's the difference? Why does it matter? So let's start off with that. Like, let's start off, most people listening probably know what an ETF, exchange traded fund, is and why it's good. But what's a closed-ended fund? You want to start off, Nick?
Yeah, so basically a closed-ended fund is very similar to an ETF in the way that it has multiple different stocks in it. The biggest difference is that on a closed-ended fund, so if you have let's say you have VOO and you have all of your shares that are in VOO are worth a certain amount. Well, however many shares of VOO that you have divided by, you know, like the math should be very equal to what the shares are, right? And I never really understood why until recently, and I thought it was really cool. But on a closed-ended fund, they don't always match, right? And so the number of shares that you have in a fund is not always equal to what the cost of that closed-ended fund is. So one that I like to trade a lot is called USA, Liberty All-Star Equity Fund. And it basically is a very high like technology fund. It has a lot of like Microsoft and NVIDIA and different things like that. And I realized that it tracks about 10% less than what the actual value of the underlying stocks are. And I never really understood why. I was like, isn't there some way of like arbitrage to be able to like get that? Well, in a regular fund like VU, there are institutional investors that if the stock or the ETF is trading for a lower price than what the shares are, you can actually convert. So you can buy VU and then convert it to the actual individual shares, or vice versa. Yeah, vice versa. If you buy all the shares in VU, you can convert that into a share of VU basically. And so on a closed fund, you can't do that. So if you ever notice that a regular ETF is trading below book value, it's probably a pretty decent assumption to say, hey, that will probably go up. On a closed-ended fund, it's not always guaranteed. USA has traded about 10 to 15% below its asset value for a consistent amount of time because they don't allow that exchange for the shares of USA for the underlying stocks. And I thought that was really cool. Nothing you or me can do about that because we don't have the regular traders can't do that. It has to be like, I can't remember the term it used, but basically institutional traders that are able to make those exchanges. But I thought it was very interesting because I've seen ETFs that have a much lower book value. And I always thought, hey, those are sure to go up, right? Not necessarily. Sometimes they stay trading at lower than what the underlying stocks are valued at. And I thought that was very interesting.
So let's say, Nick, I'm like, hey, I have like FZ and VU and all these other ETFs. Should I diversify with some close-ended funds? What would you say?
Yeah, I think there's probably a little bit more risk with the close-ended funds, just because you don't know what they're going to be valued at. But there's also, with more risk comes more potential reward. As people find more value in those funds, they may go up. And so I think it's a good way to be diversified. I would caution people because I know when I started looking into it, I was like, oh boy, these ETFs are super cheap compared to their stocks. But the reality of it is it's a completely different ball game from your regular ETFs, and so you got to be careful with it.
So will I want to hold on to it and just like, okay, in real life, like whether I own VOO or FZ Rocks, which I do, I just like buy it, let it go, right? I don't sell it and then buy it more. I buy it and let it go. If there's a dividend, for now, I'm reinvesting the dividend. Am I doing the same thing here with close-ended funds?
I think to an extent, yes. So I'll give you an example. Like again, with USA closed-ended fund, it pays out like a 10% dividend. But I've been frustrated because there's some times where Nvidia will have a phenomenal day and the tech sector will have just great gain, and they don't always translate.
Yeah.
And I'm like, why isn't this going up more? And it's basically an asset class all its own because there's the value of all of those different companies, but then there's the perceived value of them collectively in this closed-ended fund. And so it doesn't track as much. VU, on the other hand, it'll go up. If everything goes up 5%, then VU will probably go up 5%, And so you may need to reevaluate the management of closed-ended funds, and you may have to, with VU, it's just going to do what it does. It's going to track the market. But if USA has poor management, things like that, people might undervalue it. And even if the stocks don't go down, the fund value might go down. And so, you may need to consider, you may not day trade it or anything like that, but you might need to reconsider if that's the best fund for you.
So it's something where take your time, learn it, don't overinvest, but if you can build some skill with it, you can spend some time trading every few days, every couple weeks.
Yeah, kind of like most of the things we recommend here. Learn it, dip your toes in it, figure it out. It could be something that you enjoy. But I definitely encourage people to, do some research and see if it fits in with their investment strategy.
I think what's cool about all the different stuff that we're talking about is in the end, you need a diversified portfolio for retirement, and we kind of cover all those things, but at the same time it's there are ways to do it responsibly. But I think just the one thing that no one should do is just be hey, I heard about a 3X fund or a closed fund today. Let me throw $10,000 of my $20,000 portfolio into it and see what I should do. I think we have to learn it and we have to go through these and then like take your time. That I'll say is one good thing. When it comes to retirement age, we're young. We have a lot of opportunity to make mistakes. If in a year from now you're like, man, I shouldn't have ever touched a 3X fund.
Right.
You have 25 plus years to recover. And I think that's the cool thing. I don't necessarily recommend you like throw away $1,000 to learn, but it's cool that we have the time, especially like at our age. And I wish I did. I asked you this like a couple months ago. Like, you learned a lot because you made a lot of mistakes, like buying and selling stocks. And you're like, yeah, but I have less money now. So, so it's one of those things where it's like, okay, I have less money, but I'm smarter.
Yeah.
So, all right,
Oh.
here's a couple quick hitters. I talked about we had the state of economy from Federal Reserve Chairman Powell. Did you listen to that at all or see anything?
I did not.
So I had a video that I talked about, and we talked about just like the state of the economy and my thoughts on the state of the economy. And here are just some quick thoughts from Chairman Powell. He said, at the Fed, we're always focused on a dual mandate goals given to us by Congress, maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is in a strong position. Now, these next two sentences I find intriguing. The labor market is at or near maximum employment. Inflation has come down a great deal, but is running a bit above our 2% percentage. For context, the CPI, which is how the consumer price index, is at 2.4. Goal is 2. March, we were down negative 1%, so prices were down in March. Not just slowed down, but prices were down. So just starting there, what's your initial thought? Because I know, like, if Dylan was here, he's like, are we on, like, do we have a recession coming? The labor market is at or near maximum employment. Let's start with that. What are your thoughts on the job market in the economy?
Yeah, I think there's always been this thought when it comes to the employment rate of like, maybe that number is good, but what is the, number of gainful employment, right? Like, what is the, or, things like that. And so at face value, I'd say, well, that sounds like a really good thing, right? Like if we've got as many people working as we need. But I would question, are those minimum wage jobs, entry level jobs, like what percentage of that, is the average U.S. Family bringing in more money today than it was 5 years ago?
Sure. Yeah.
Like that's where my mind goes to. And I think if those numbers are a way to say, yes, the average American family is bringing in more money today than they have been, then I'd say that's great. And all of this wonkiness with the stock market will probably fix itself over time as, companies report earnings and things like that. But if we're bringing in less money, I guess it doesn't matter how many people are working, because it's still going to negatively impact the economy. So I don't know if that one metric by itself is enough for me to say like, ooh, good news. Like it sounds like it's good news. I'm not trying to be a Debbie Downer or anything, but it's just not enough for me, I guess.
Okay, that's the labor market. I'm optimistically cautious. Like the labor market was like kind of shady the last couple of years. So we kind of have to wait to see. What about inflation? Inflation, there's like, okay, in 2022, we are at like 8-9% inflation. We're at 2.4 now. What are your thoughts there?
Yeah, I mean, inflation in itself, I guess, is, getting that under control is definitely a good thing. So as we're moving more into a less, just call it crazy, I feel like over the last couple of years of inflation, getting back to some normalcy, I think is a good thing. I also think that I don't know. And this is, hear me out here, because I think I would argue inflation versus the value of the dollar against, global economy. But
Yeah, yeah.
if inflation continues to go up, then that means like buy things now because they're only going to increase in value later. You know what I
Yeah.
mean? And I think that in itself could be a good thing if it's left like checked and it doesn't get too crazy where people can't afford houses and stuff like that. I think inflation, like everything has to rise, right? Like wages have to rise with it and things like that. But if I buy a house today, if I buy a car today, it's likely that the value of those things will go up. And I think most people who are investing in things like that would say that's a good thing. Now, I think for your
Right.
renters and minimum wage, things like that, that could hurt. But yeah, I think it's probably good that we have some lower inflation because we've definitely been
I know,
rocked
right?
with some craziness. But I also don't think that inflation in general is necessarily a bad thing as long as the U.S. dollar stays strong in the global economy. I think that our products and things are just worth more.
Right.
I don't
Yeah.
know. I kind of enjoy the idea of some protection that what I buy today isn't going to be worthless tomorrow, if
Yeah.
that makes sense.
Yeah. So I think it's good. Like a 2.4% is the Fed's goal is 2%. And kind of like you said, the like they kind of don't want to go underneath 2% either, you know? Like they want to be at 2%. Um so I while you're talking, what you mentioned like wages and stuff, I was reading this article on Wall Street Journal. It was an opinion piece saying we should measure prices in time, not CPI. But they okay. So, according to the Bureau of Labor Statistics, between 2000 and 2024, the CPI increased by 82.2%. So, inflation essentially went up 82.2%. That when I first read that, I was like, "Really? That's huge." The next part of the sentence, while hourly earnings for production and non-supervisory employees increased by 115%. Hourly compensation thus was 40% faster than CPI. I was pretty surprised by that to hear that. What do you think?
Yeah, so I mean, basically, what it's saying is that entry level jobs pay went
Yeah.
up more than inflation,
Yeah.
which which would essentially mean people have better lifestyle now than they did before,
Yeah.
right?
Yeah. Essentially, yeah.
Yeah, I think that's a good thing. Right? Like that's
No,
what we're
I
trying to get.
agree. And this is why I am a little optimistic because after COVID, we had the potential to like an economic crisis to kind of get out of hand. I mean, like COVID should have been worse than it was because we essentially weren't working that much and like weren't buying anything. We weren't spending money. And that's just like one of the worst things you can do for the economy is not make money or spend money. So it's interesting to see that, but I think there's like so for someone like you probably know, but GDP is like the US has the biggest GDP in the world. But some criticisms of GDP is like, well, if you have a big population, is that does that all come from billionaires? Well, our GDP is pretty good per capita, and our lower class is earning more and beating inflation, at least historically over the last 25 years, which I think is good news. So that's where I'm optimistic about the state of the economy.
Yeah, I think that's the stuff that makes what's happening right now in the stock market so crazy is
Yeah.
because there's no like underlying like, oh, the poor are getting poorer and
Right. Yeah.
the like nobody has jobs, people can't feed their families. If anything, it seems like kind of the opposite of that.
Yes. Yeah.
And so to see the market doing what it's doing, it's got to be based off of fear versus people actually not having the money to be able to invest in things like that. So yeah,
Yeah.
I'd say very good thing for long term success of the stock
Yeah.
market for sure.
Yeah. And like for me, when I think about the struggles of the stock market, I think I hate to be this guy, but like a bunch of like stock traders on Wall Street just dropped our portfolios because they're like, oh, what the heck is going on? I'm selling, you know? And it's like, thanks, bro. You know, you just made my portfolio drop 10%. The other thing I think is ooh, I like everything just got a little bit cheaper. You know, like it's kind of like a good distribution of wealth for people if they want to buy it while all the millionaires sold off a bunch of their assets.
I like it.
So, okay, last thing, this is what we'll finish on. That there is still concern about tariffs and the impact of tariffs on pricing. So, for anyone who doesn't know, there was Liberation Day and our stock market essentially had a 2-day mini crash and everyone lost their minds. And for whatever reason, President Trump said, well, we'll wait a little bit on these tariffs. There's still the idea, and Jerome Powell talked about how tariffs, at least in the short term, could impact prices. He did state later on, like past this speech during a conversation, that like if like businesses could take advantage of the fear of tariffs and start raising their prices now and say, well, tariffs, and we're like, okay, well, tariffs, I have to buy them, even though tariffs aren't impacting us yet. But tariffs could impact inflation, just increase prices, even if it's like a scummy thing that a business could do. What are your thoughts on like the future of inflation with tariffs? Are you worried? Are you concerned? Are you optimistic?
Yeah, I think, tariffs are a very complicated economical process, and I don't know that it's easy to just say good or bad.
Yeah.
I think that I don't know that you can just say good or bad on tariffs. I think that there's an argument that it could help, bring more jobs to the U.S., stuff like that. But
Yeah.
honestly, with the way capitalism is, there are going to be companies that are going to take advantage of that and say tariffs, higher prices, and things like that, which, on the surface sounds scummy. But when that company announces earnings and their stock price goes up, if I own their stock, I'm going to be happy. So, I don't know. I think I'm humble enough to admit that I don't know what's going to happen exactly. I think if as people are scared, stock prices are more likely to go down. But I think if we do this and companies still, record profits, families are still able to afford groceries and everything, then I think, yeah, it probably will help the economy and it will help in long term. But maybe there's just going to be some short-term pains before we get to places like that. But to your point, there's going to be people that are going to take advantage of it. It's going to raise prices, whether that was because the tariff or because somebody could justify a reason for a price hike. Yeah.
All right. I think we're in agreement here, and I wish tariffs just weren't so political right now, because people stop thinking, like historically, if you just talk to 90% of economists, they're like, no, I hate tariffs. They're taxes. They're tax increases. Those same people will probably say, yeah, our tax increases on businesses are bad, but people who hate tariffs want tax increases on businesses. So it's become so politicized where people just don't fully think through the process. But all right, that's the state of our economy and our thoughts on the economy. Nick, thanks for hanging out today.
Yeah, absolutely. And in honor of our, our buddy Dylan, I'm going to ask you: are we in a recession? Is it time to panic?
I will say I am cautiously optimistic. How about you?
I think I'm kind of in the same boat. I don't know if I can say the worst is behind us, but I think, a year from now, 2 years from now, we'll be in a good spot. I'm not worried about it. So
yeah, I feel good. Still more to come. The tariffs, right now the tariffs have basically just messed with our stock market, and that's it. And just talking about tariffs, the stock market's like, no, don't even say that word, and then it drops. So, all right, well, thanks for watching, team. Have a great day. Adios.
See ya.